welcome to the Power and Market Report. I'm Albert Liu, joined today by two friends, Rick Rule, founder of Rule Investment Media, and Lobo Tiggre of the Independent Speculator. Guys, welcome. How are you?
Albert, right, pleasure Albert, to be with you. Thank you.
I got to remember to stop doing that when we have two guests. Rick, Lobo, it's great to see you both in New Orleans. Lots has happened since then. We got a lot of market news to cover, but just, I guess, your thoughts now on the market overall before we move on. Dow's up today over 0.5%, and people are all over the place in terms of what they think the Fed would do, should do. I heard recently people saying that perhaps they should be done, then they go again. Guys, what are your thoughts? I'll start with Rick on the economy and what you think is, I guess, appropriate, and then contrast that with maybe what you think they'll do.
I'm struck by the old phrase that there's a lot of ruin left in a country this great. I would have expected, with the move up in interest rates that we've seen and continued political uncertainty in the United States and trying geopolitical concerns worldwide, I would have expected the interest rate rises that we've already seen, particularly the interest rate rise around the 30-year fixed mortgage, to have a much more deleterious impact both on the markets and on the U.S. economy. But the U.S. economy continues relative strong. I realize that labor force participation rates are down, but everywhere you look, everywhere that I have been, and I've been traveling a lot, you see help wanted signs. There's a sign on the Safeway here in town promising $20 an hour to start. That is to say, a training wage. And in the face of a 100% increase in the interest rates in 12 months, I think that's frankly an amazing sign. I understand that this increased cost of funds has a lagging effect, which is to say that the response in the market and the response in the economy is not immediate. But I'm still struck by the relative strength I see in the U.S. economy, particularly against my own consideration, my own, sort of suspicions and prejudices. I also want to say on the other side, there is a lot of cash on the sidelines. The old clients I talk to, I'm retired now, but the old family offices and ultra high net worth people I'm talking to are unanimous in the sense that they want to deploy cash, but they're afraid. This could be something that in the very near term gives us a mini melt up. I'm not a stock trader, so I don't care about mini melt ups. What I'm interested in is companies that are selling at discounts to net present value. But I understand that our customers, the people listening to this interview, are very concerned about near-term market conditions. And I suspect the relative strength in the U.S. economy and the incredible amount of cash on the sideline says that in the near term, markets could be, stronger than we expect.
Rick, I find it funny, and I guess your sentiment is not uncommon in that when you see help wanted signs, that's a sign of a good economy. We're conditioned to think that people being unemployed involuntarily is bad. When people are not being offered enough to work, hence hold their labor off the market, that's supposed to be a strong economy, but it's just broken in the other way, meaning wages have to go up. And that is going to have a dampening effect on the economy. So why either of you, feel free to answer. Why do you think that when you have a wage imbalance in one direction, it's considered good? Meaning they're not offering enough, so people aren't working, so there's help wanted signs everywhere, and that's a good thing. The economy is strong.
Well, there's a certain point there. We have had a circumstance at the lower end of the economy for a long time that people weren't getting paid enough to live. They just weren't getting paid enough to live. You get an entry-level job at McDonald's and you can't afford a hamburger. An odd thing. I'm not so sure that the investments that we've seen in the service sector in the last 10 years, the amount of capital that's been deployed in the service sector, which is to say cash registers at McDonald's with icons so that illiterate people can work them, is a bad thing. By employing technology, it might be that we can finally pay service workers enough for them to live. But I take your point. I take your point that the underlying inflation in the economy particularly around government and housing, has been such that labor force participation at the bottom end of the labor force is discouraged because people will say, why would I work 40 hours a week if I can't make enough to live? I do take your point, and it's a good one.
Lobo, is the economy strong?
Let me rewind the conversation a little bit here to go back to something Rick started with in the previous segment, in that I too have been surprised by the turn of events, by the relative strength that you're asking about now. Earlier on, and the writing was on the wall that the Fed was behind the curve, they would have to catch up. And it seemed that would make things go bottoms up, right? That they would break something. And some very smart people were saying that the U.S. budget couldn't handle interest rates at normal levels or even half of normal levels. That 2% or above interest rates would start to cause serious problems for the federal budget. Here we are at 4%, and nothing has blown up yet. So earlier this year, I had, before the summer, I had been sounding the alarm of a potential market crash because of what the Fed would have to do to catch up. And then that started happening, and the market was loving it, right? I mean, no crash. We've had a fairly relentless grind lower since then, but nothing that really qualifies as a crash, which fits in with what Rick is saying about all this cash on the sidelines. So I rolled that back. I said, okay, I'm not saying the markets won't ever crash now, but let's pull off the red alert on market crashes because this just doesn't look like a market that wants to crash. So I too have changed my stance here in response to the incoming data as we see it. I don't think I'm the right person to get involved in the wage price spiral conversation you and Rick just started. I think that's real, but let me do my own pivot here to our good friend Doug Casey, mutual friend to us all. And he likes to say that the best way to speculate is to look at what the government does, and you can count on them always doing the wrong thing. And so I think a lot of what we're talking about right now can be squarely laid at the footstep or doorstep of the government, which did the wrong thing, right? Even if you think that the immediate response to the COVID shutdowns had to be a flood of generosity, fine for 2020, not good for 2021. And even Democrats now are willing to say that maybe the government went too far in 2021. So lots of home offices and big investors have a lot of cash on the sidelines. No surprising. Government gave a lot of people a lot of cash. Lots of workers don't want to take a job flipping hamburgers for, I can't quite agree that they can't live and can't buy a hamburger, but it may not be enough to buy the 27 different media platforms that they want to watch movies on and the designer sneakers they want to buy and all these other things that are absolute necessities in modern life. So they got given a bunch of cash too. And it hasn't even really stopped entirely. So, they're empowered to demand higher wages. I mean, basically what I'm saying is the government flooded all aspects of the economy, from high-level investors to hamburger flippers, with tons of money. And we're seeing the consequences of that. So it's not surprising. We could make a great macro story on this, this thing. But it's easy to get caught up in these macro stories. The big thinkers, as Rick likes to say, and their spiels. And that gets distracted from what we need to do as investors now. So I'm not sure I'm helping out here, Albert, but I'm much more interested in saying, what happens now, and not the imminent, not the inevitable, Rick, but what's happening now, and how do we invest based on that? And what's happening now is, despite various politically motivated parties doing everything they can to avoid the reality, is impending recession, if not actual recession taking root in Europe, in the UK, impending recession in the US. The strong economy that Rick pointed to, I agree, it's been stronger than we thought. That doesn't mean the layoffs aren't coming. We already see that, Meta, Amazon, these big boys, little companies. I think it's coming. I think it's going to be bad. And I think that's what investors need to be focused on preparing for right now.
Possibly part of the reason that, you say crash is not coming is because the crash has already come and it's really masked by these market-weighted indices with, the best of the bunch, Microsoft, Apple, and so on. If you look at the other companies, you've seen it. And as you point out, we've seen layoffs. We've seen hiring freezes at the both extremes of the market, the mega caps and also the smaller companies. So let's move on to what we should do now. A lot of people hinging their hopes on China reopening. You have, Apple, big concentration in China, Starbucks as well. China really determines a lot here. And we have a story this morning. CNBC, Goldman Sachs says China is still months away from reopening. So, Lobo, let's have your opinion. The importance of that. What can we believe? What should we believe in terms of if and when this market is going to open up again?
Yeah, well, a couple things on that. Obviously, I'm not a China whisperer, and even the best experts on China are often wrong. I like the China Beige Book guys, but it's really, really hard to call when there's basically 100% opacity on policy. But to be practical, I think reality matters. China clearly cannot adhere to the zero COVID-19 policy so strictly forever. I mean, it will undo the China miracle if they do that. You can't stop the economy forever. This has to end. Of course, Emperor Xi, recently crowned, can't possibly admit to any kind of policy error. So I think they move the goalposts. I think they redefine. I think that's what we're starting to see already. Instead of locking down entire cities, they're talking about, in the same breath that they say, we haven't changed anything, we're changing to focus on neighborhoods now. We're going to do even more testing. We're going to focus on blocks instead of neighborhoods. We're going to be more targeted. That is significant change from locking down entire provinces and cities. The economic impact is different. So I do think we're going to see change. I think it's probably not going to be too visible until after this flu season, which is just starting up, and we are going into the winter in China. And that is a time to be cautious. But on the other side of that, I think we see changes, even if they're never publicly acknowledged as such. And the one last thing before I hand it over to Rick on this, I think it was really telling. What we saw Friday was this huge surge in not just Chinese stocks, though I understand $1 trillion, not yuan, $1 trillion was added in market valuation in a day based on a rumor of reopening there. So, if that can happen just based on a rumor, imagine what happens when the reality starts becoming evident. And Chinese stocks aside, this is huge for commodities, which is near and dear to most of our, right, gold bugs and metals and mining investors. I think this is extremely telling. It's not like the starting gun at the beginning of the race, go off and charge ahead, but it is a bellwether signal of things, very important things to come. And finally, the other part of this is that it didn't just move Chinese stocks, it moved the yuan, which had an inverse effect on the dollar, which boosted gold in spades and silver on steroids. So monetary metals acting as they should in response to a monetary phenomenon. I think all of this is very important. And while, our gold stocks are in the doghouse now, long-suffering gold and silver bugs are worried about tax loss season, and I think rightly so. These data points that we're seeing in the global economy, I think, portend very good things to come, maybe not immediately, but in 2023.
In the same article, Goldman's quoted as saying, "We estimate that a full reopening could drive 20% upside for Chinese stocks." Lobo, as you point out, enthusiasm obliterates these estimates, even the rumor of a reopening. So you can see quite a bit more upside. But Rick, let's take it.
Sorry, one more point before we hand this over to Rick. Sorry, yeah. Albert, let me jump in one more.
No,
thing.
It's okay.
The other thing that's quite striking about this is this happened on Friday. The same day we got the jobs report, which was a total blowout beat on the number of new jobs created. They were looking for maybe 190,000 or less than 200,000, and it came in at 261. Now, of course, I don't believe any of these numbers. They're all massaged. But whatever the number is, whatever it really means, it was way higher than expected. And the marginal tweak up in the unemployment rate is still at 3.7%. I mean, that's de minimis. It doesn't matter. On that jobs beat, after the Fed talking so tough about the fight on inflation, markets should have tanked on that. But this China story, just based on a rumor, was enough to swamp what otherwise would have been, a major driving force in the markets on Friday. So I think this is evidence of interesting times to come, as the Chinese like to say.
Or maybe
Sorry, go ahead. Take it away.
Maybe suggest the source of that rumor, given the utility in propping up markets. But Rick, let's assume that an opening is in the cards, and obviously it's going to be good for the broader market. But if we bring it closer to home, closer to your expertise, commodities and monetary metals, what does a reopening of China mean?
Well, I think it's probably bullish, at least for industrial commodities. The Chinese, an example, are more than 50% of the inbound iron ore market. God knows what their market share is in coal now. They seem to be the only ones admitting to buying it. So to the extent that the Chinese can pivot, if that's the right word, out of their malaise, it's extremely important for a whole range of industrial commodities. With regards to the precious metals, I think there's two things to say. The first is that the Chinese government would appear to have a policy that suggests increasing exposure to precious metals in terms of their reserves. You can understand if they see themselves locked in a Cold War with the United States, that they probably wouldn't want to accord the United States the benefit of seigniorage and hold U.S. 30-year treasuries, particularly given the negative real yield. It's also very true, which we saw in the early part of the decade of the 2000s, that there is a cultural affinity to precious metals among Chinese people. To the extent that Chinese people have more disposable income, I suspect you may see the phenomenon that you saw in the middle part of the decade 2000 to 2010, which is to say concerted retail buying of precious metals, which is overtly encouraged by the Chinese government. I guess the only counterpoint to that would be a global recession, which would, irrespective of the opening of China, grind their export machine lower and make less disposable income, both for Chinese consumers and the Chinese federal government. There's a lot of moving parts in all this, and we need to realize that while our audience wants simple declarative statements about how the world is going to be 12 months from now, I think the three of us are fresh out of those. All you can do is discuss a range of probabilities.
Rick, it's hard to deny that a recession is also in the cards, whether people want to admit it or not. We may even be in one now, but one more serious because you see the liquidation is not anywhere near what one would expect, given the excesses that we've lived through in the past years. Is your opinion that a recession will be short-lived, or what are your thoughts? Because going to Casey's maxim, the government is going to do precisely the wrong thing, and I think the wrong thing would be to kick the can down the road and try to pump this thing up again.
Doug and I, between us, have called 17 of the last 3 declines very accurately. He and I both share the same fears. I think being brought up in the 60s and 70s, we saw how wonky things can get when you have sort of a global sea change. I have long suspected that we were due for a recession. I had imagined that higher interest rates would cause that to occur sooner rather than later. I have also been afraid of a liquidity squeeze, some type of black swan event that would cause confidence among the banking community to disappear along with liquidity. That hasn't happened. I think in Great Britain, the circumstance that we saw around the long-term gilt market, both in terms of the declining values because of increasing interest rates. Those increasing interest rates, of course, make longer-dated issues at fixed lower interest rates less valuable. But strangely, the fact that some of the largest pension and endowment investors in the world were leveraging their long-term holdings, borrowing short, lending long, in a circumstance where both their borrowing rates increased and the capitalized value of their securities decreased, that's precisely the type of black swan event that, irrespective of a recession, frankly scares the hell out of me. If I had to figure out one thing that might be a black swan, and of course it's difficult to forecast black swans because they're supposed to be surprises, but the nature of the impact of very deeply negative real interest rates on the long-term bond market and the underlying illiquidity in the junk bond market really, really scares me. And I think in addition to investors paying attention to the threat of either an American recession or a synchronized global recession, we really do need to consider the impact on the largest institutional investors in the world of rising nominal interest rates, but declining or static negative real interest rates. That puts these guys in a tremendous, tremendous bind. And I to be honest with you, hope it doesn't blow up, although obviously that would do probably wonders for the value of my gold holdings, but maybe for the wrong reason. Sorry for that long-winded answer.
No, Rick, that's quite fine. And since you bring up this the gilt market, I guess there's a philosophy out there or a joke that says you just raise rates until something breaks. And certainly the UK succeeded in finding that threshold. I'm wondering where that threshold is for US markets, particularly the consequence, the knock-on effects on emerging markets. Do you have any idea roughly where that point is?
I don't. I would have expected that we would be approaching it. Certainly what you talk about is interesting. The emerging markets were able to lower their near-term interest rates by borrowing in US dollars, but a circumstance now where virtually all those currencies, with the possible exception of Costa Rica and Zambia, those two global superpowers, all of those currencies have been declining in US dollar terms. So these countries need to pay their interest in US dollars. and they need to pay them in a bunch of currencies that are declining against the U.S. dollar. These are real problems for them, but it isn't just the emerging and frontier market that's a problem. I think there's plenty of hidden sin, particularly among non-investment grade securities in the U.S. corporate market, and there's probably a lot of sin in the recourse or off-balance sheet obligations of state and local governments that we haven't seen. We've seen discord in the treasury market, but the treasury market is deep and liquid and attracts so-called safe haven money. Where I'm really concerned is, yes, frontier markets, yes, non-investment grade corporate market, so-called junk debt, and yes, state and local obligations in the United States. I'm really concerned about that.
Lobo,
let me jump in with a question here.
Sure, yeah.
I'm not a bond king, so I'm I'm not the one to address that kind of question. But I have a question actually to add on to this, Rick. I've been watching this, and I watch the talking heads on mainstream financial media, and they're all so joyous because we finally have real yield. And I'm looking at inflation 8-9% and bonds or bills and notes at 4%. Like, what are they talking about? And my understanding is that what they mean is by maturity, right? They expect inflation to come down, right? It's going to be 2% by the end of next year, right? Therefore, by maturity, we have real positive yields on these bonds. But that's an assumption. And and not just an assumption on the sun's going to rise tomorrow, but the assumption that the Fed is going to bring inflation back to 2% at all, or if it does without destroying the economy. It strikes me as a breathtakingly, obviously problematic assumption to make. And yet these people are on TV talking about real yield, like this is a thing now. And you safe investors can buy these bonds now. Isn't that inviting the very sort of problem that we just saw in the UK with people thinking they're being clever and safe, investing in the most trustworthy government bonds in the world? Am I missing something, or am I exaggerating, or you're grinning?
I don't think so, Lobo. As you know, my sort of commercial background is a credit analyst. And we had a saying 45 years ago, which I believe is true today, which is to say, assumptions are not collateral. Um, we have a circumstance now where the U.S. Treasury,
That's
the
very good.
U.S. 30, the benchmark security, yields what, 400 basis points? In an economy where the Congressional Budget Office says that the purchasing power of the currency is declining by 8.9% compounded, which is to say that the U.S. government is absolutely positively guaranteeing you a 500 basis point negative yield based on the current numbers. As you say, the big thinkers are making the assumption that inflation falls. Good on them if they can cause that to occur. I'm reminded that Gideon Gono had the same idea in Zimbabwe, and I realized that there's a difference in terms of the underlying strength of the Zimbabwean economy and the U.S. economy. But the idea that you can use an assumption around inflation as justification for buying a security where you're locking in a 5% negative real yield is problematic for me. Now, I have a very, very, very large former client, a family office that I stay in very good touch with. And I ran this scenario by him meaning the sort of scion of the clan. And I asked him not about the US 30, but about the US 10, because I know that he's a very, very, very large holder of Treasury securities. And I said, I'm interested in what you find attractive about a guaranteed 5% loss. And he said, because I think it beats the hell out of a 20% loss. I want to have liquidity. And I know that the U.S. government, if worse comes to worse, can print my payment. I'm very cognizant of the fact that owning the U.S. 10 puts me in a circumstance where my purchasing power declines by 5%. But I'm nervous enough about long debt markets and nervous enough about the equities market. And for that matter, nervous enough about the commercial real estate market with increasing cost of capital that I would rather lose 5% than lose 15%. And I think that may account for some of the strength in the U.S. Treasury market. I don't mean just this person. I mean that way of thinking. I know myself, I have a lot of one-year treasuries. The idea that they're going to pay me more to hold the money for 1 year than they pay me for 10 means that both of us are happy with the trade, because I don't want to give them any money for 10.
Rick, how widespread do you think that feeling is among family offices? Any idea?
Yeah, I think it's probably worth discussing that as a bifurcation. You know, the economy that we've seen in the last 10 years, which is to say cheap credit, has been an overt subsidy for those who have access to credit. Folks like me, you know, we talk about on the one hand all the people that receive stimulus checks. Well, as a commercial borrower, I got a huge stimulus check. I mean, an amazing stimulus check. And I think what you describe is accurate. I think that there are some people in the last 10 or 15 years that made more money than they had previously known existed, and they're pretty determined not to give it all back. They, in a lot of areas where they made their money, one particular family office I know made their money in developed real estate, and they're suggesting that the era of low cap rates with rising interest rates is over. So they've been going out of these commercial real estate investments and have nowhere to put the money. They made their money, a lot of money in the last 15 years, but they made their money over 40 years developing commercial real estate, having the return on capital employed increase slightly, while their cost of capital, which is to say long-term financing rates, have decreased. It's a wonderful delta for 40 years. They see that as being over, but they don't know where to put the money. And I think that is occurring all over the place in the family office market in the U.S.
Okay, why don't we finish off with some encouraging news, and that is a bidding war, but not a bidding war for California real estate or NFTs or the new, the latest IPO on some tech company. It's actually a kind of a bidding war for Yamana Gold. Lobo, why don't you introduce us to that story, and we'll have a discussion with Rick.
Okie doke. Before we go, and I do think it's telling, I think it's useful to have that. But before we move on from banking, I want to ask Rick a question. It's kind of funny that we're talking about all this because you in your retirement have decided to start a new bank. Like, WTF, as they say online, in the first place. Like, how is that retiring? B, okay, I get it, online bank. We all miss EverBank. I get the general premise. But when I brought a gaggle of ducklings by your booth, you make splendid booth bait, by the way, in the show in New Orleans, and you gave us a talk, and you talked about how you have services for gold bugs, and you can leverage your gold. And after we went by, a lot of my audience, they looked at me like, why would we want to do that? Gold, Doug Casey tells us it's the long for which there is no short. It's something that we can stuff under our mattress and sleep well at night, except for the lumps, because we have the security of the world's longest serving safe haven asset. Why would we encumber it with leverage? What is he talking about? So before we move on, let me ask you, Rick, why the hell would you start a bank in retirement? And two, why the heck would you ask people to leverage their gold? What's up?
Let's deal with them in that order. I decided to back Frank in starting a bank in retirement. By the way, I'm not going to be your banker. Let's get that clear. Because I have relationships personally with 4 very large global scale banks, and I dislike them all. My best banking relationship personally is one where the bank has me sullen, but not yet mutinous. I love holes in the market where there's a great big market to be served, and my competition, while numerous, is inept. And I see that in the banking business. I'm a really good banking client, When I borrow money, I pay it back. I run fairly large deposit balances. The profitability on me relative to what is required to service me is extremely high. And the 4 banks that I have relationships with can't get that right. So there's a hole in the market. I think this is a wonderful time to start a bank because banks have built up so many bad habits in the last 40 years. For sure, Lobo. For sure, I can't compete with Bank of America. For sure, Bank of America can't compete with me. What is half a crumb to them is an absolute banquet for me. Now, let's move on to the gold. We anticipate that there's about $35 billion worth of bullion held by U.S. investors in a form that we could access as collateral. That doesn't include, of course, the gold and silver that's, let's say, subject to a midnight garden as a custodian, but rather gold and silver in segregated holdings in vaults. I don't need to lend against $35 billion. The fact is, I don't have $35 billion to lend. I need to lend against about $1 billion of that $35 million. And I think for many of the people that you've described, gold bugs who are looking at gold as a form of liquidity and insurance, they aren't going to leverage it. I'm not going to leverage my own gold, probably, although I would like to have access to capital if I wanted it. It's interesting in the discussions that I've had with people about what they'd use the money for. My interpretation was that somebody would have, say, $1 million worth of gold and need to access that gold for short-term liquidity, to take advantage of an investment opportunity, buy a rental property, something like that, put down a down payment on a summer cottage. It turns out that in 8 of the 12 conversations I've had, the purpose is to go from an investment holding in gold to a speculative holding in gold, which is to say they were going to use the proceeds to buy more gold, to treat it as a margin loan. The truth is, from a banking viewpoint, if I'm well collateralized, if I'm lending money against gold at 50% loan to value, I care less about what the borrower intends to do with the money, the proceeds, because I'm very, very, very well collateralized. From a lending viewpoint, being collateralized by a commodity that's as liquid as it is a banker's dream. And the fact that none of the, as I like to call them, big thinkers are willing to consider gold and silver as an asset class worth lending against just cracks me up. It absolutely cracks me up. They would rather, buy San Diego city bonds where the city's $1 billion in arrears on its pension obligation and you can't sell the bond. This is, to me, the idea to make a loan at 50% loan to value to a fairly conservative borrower with the collateral being highly liquid. I think it's a wonderful product that the market needs, and I'm delighted to serve.
Well, that's
Rick.
very interesting. You, of course, being a loan shark, don't care how it works out for the guys. As you get paid one way or the other, you got the collateral. I get that. I love that.
From a lender's viewpoint, so you want it to work for the customer because it lowers your marketing expense. But let me give you a couple other examples. The best lending space I know, the lending space I grew up in, is the oil and gas industry. And the politicians have said to the big banks and the insurance companies, the traditional oil and gas lenders, we're going to make your collateral valueless in 6 years. Or 8 years. These are going to be stranded assets. So the very largest institutional lenders in the oil and gas space are leaving the space. And I don't think the big thinkers are going to be able to make those stranded assets. I believe that peak oil demand will occur in 2045. The idea that as a bank, I can participate in a sector like oil or, heaven forbid, coal, where the incumbent lenders who control the market are exiting the market. And some of the best borrowers in the world are forced to come down and borrow money from little old Rick. I can't see a better world than that. It's just absolutely spectacular to me that absolutely wonderful businesses are decapitalizing.
Okay, well, congratulations to you for that. Let me come back to my gold bug friends. So the answer I'm getting here, and I hadn't thought of it this way before. So I'm thinking more of the 8 out of 12 conversations that you've reported, right. Basically you're a bull. You think gold's going much higher, so I can gain leverage to that upside. I guess if I'm a big bull, I could see that, but my druthers, my way of being, I don't know, my character, that just runs completely against my notion of why I own gold at all. And I can be right about gold going way up in my bull thesis, but what if it's at a time frame that makes the fees inconvenient, let's say? But the other thing that you said that you expected and didn't hear, I think that actually makes sense to me. Like, I could absolutely see that. I'm a gold bug. I've got a bunch of gold, and I want to buy a new house, right? Mm-hmm. And if I can collateralize the gold to get better terms on my down payment and do all that, but I don't actually want to sell my gold. I don't want to get rid of it. If I take my briefcase full of $1 million of gold down to my local coin shop, I could get the money, but then I don't have the gold. Whereas with you, I presume the rates charged given the strength of the collateral, the rates charged would be modest, and I could then get my new house in motion without giving up my gold. That actually appeals to me, and I hadn't thought of that before.
I was able myself 4 years ago to do effectively that. The bank was very concerned for whatever reason about taking my gold as collateral, which made me laugh, thinking about other forms of collateral that I've seen them take over time. And I was able to use the liquidity afforded by my gold to buy an asset that I knew I could refinance in the fullness of time at a lower and, much more importantly, fixed rate, long-term fixed rate, which I was able to do. And I had thought that there would be a reasonable number of investors and speculators, well-heeled, who were in the gold market, but had suffered from liquidity issues. They had all of their spare cash in gold and needed liquidity for some other purpose. And I still suspect that there's a rather large market of people like that out there. Time will tell, of course. The idea that the size of the market in the United States, which is to say gold and silver in storage that is adequate collateral for us, is, we estimate, $35 billion. I don't need 100% market share there for my bank to work. Being able to service the liquidity needs of a much smaller number of bullion holders is sufficient for the glorious success of Battle Bank.
Rick, it'll be interesting to see what the numbers work out being, because that was my thought as well, that there's a fraction of that 30 billion market that is so enthusiastic that they have nothing else that they can leverage, and they've realized Warren Buffett's wisdom that gold, you can't eat it, it's not shelter, it's not this and that. It's a wonderful thing, but it's not a consumable in the regular sense that we think about consumables, and people are probably going to look at an unfavorable environment for selling it in terms of taxation. And Lobo's point too, maybe get the best terms on their gold, even if they have other assets that they could margin based on the quality of the collateral. Great.
If I'm right, Albert,
not to beat that to death, but let me just say this actually happened. Now that I hadn't thought of this before this conversation, but this actually happened to me, Rick. 8 years ago when I bought my apartment here in Puerto Rico, they're going through all my assets and all this stuff, and I'm like, okay, I have, X thousands of dollars in physical gold. I've got this many they're like, what? And I sent them a picture. Like, here's my stack of gold. Like, I have this in my hand. It is, and then, no, we're not counting that. And I don't remember if I had to sell some stocks, but I had to scramble a little bit because I'm thinking I've got this asset, and the banks, none of them. It wasn't an asset at all. They would not count it as, it's like I was showing them seashells from the beach or something. No interest whatsoever.
In 2008, 2009, when we had that sort of liquidity and confidence crisis, I know myself, by having access to by having cash and having access to credit, 2009 was a very good year for me. And I don't think it's unlikely that we have a liquidity problem in the next 2 or 3 years. And for those investors who don't want to sell their gold, but want to have access to cash, access to credit, to take advantage of market dislocations in a point in time when other investors don't have access to liquidity, I believe there's a very large market for that.
All right. Well, I just had to jump in on this question because I had a lot of people ask me about this after New Orleans, and we're talking about banking, so why not? Albert, do we still have time to talk about that merger activity?
Just a couple minutes, Lobo, because we're coming up on an hour here. Lay it out for us first, and then we'll get both of your takes on it.
Okay, so there's two things. One is we've all been waiting for this big wave of M&A that seems to have been put into abeyance by the COVID-19 lockdowns. People couldn't travel to do due diligence. I had trouble. There are mining companies that would say, well, we'd love to have you, but if somebody in the nearby village sneezes, we'll get blamed. So we just can't have anybody on the property. So that was started 2 years ago. And mining companies, by definition, are literally, their business puts them out of business. The mines are depleting assets. You have to either discover more or buy more. And we all know that the exploration budgets have been slashed for a long time. The discoveries have been few and far between. So there's this perception that M&A is going to pick up in a big way. Hasn't really picked up in a big way, but this is, I think, a sign that there is appetite for that. And this is important because a lot of us, especially in the junior space or mid-tier space, we're invested in assets that are likely takeover targets. That's one of our ideal outcomes as resource speculators, is a takeover. It's the ultimate liquidity. So I think it's just important just in terms of sign of the M&A market. And the fact that Yamana first gets an offer from Gold Fields some months ago, and then now two other companies partnered, Agnico Eagle and Pan American Silver, to make a superior offer. It shows the jockeying amongst the larger players here and the fact that they do need to get ahead and get going with this M&A activity, or they will become smaller companies. So I find that very encouraging. And the fact that it could turn into sort of a bidding war is even more so. That shows that the appetite out there is real and it's strong. Now, I'm not going to make a recommendation on any of these companies. I think I follow all but one of them in my take, one of our publications. But I will say that I have to give a hat tip to management at Gold Fields. Just as we speak this morning, I saw the news that they are declining to raise their bid. And I think that is commendable. I think, it's great if you own the shares that are subject to the bidding war, you get, this wonderful payout. But it's not great if you own the shares in the companies that are participating in the bidding war and somebody ends up overpaying. I mean, usually the initial bid is a reasonable bid. It's a win-win. The second one may or may not. It might be a little rich, but you go with it because you get the asset. But after that, usually somebody ends up overpaying. And so the winner actually can be a loser for the shareholders, if you understand what I'm saying. And I think we've seen, I'm not going to name names, but there have been cases of that where I thought there were too many rounds in the bidding war that resulted in overpayments. But bottom line, I think this is actually quite encouraging for resource speculators, even in recession or, all this other stuff we're talking about. If you pick your stocks carefully for those with, higher odds of a takeover, you can wake up in the morning and find a 50%, payday. And that's a thing of beauty.
Rick, before you break down this deal, I just want to get your thoughts. What does it say, the fact that there is a bidding war, what does it say about where we are in the M&A cycle?
I think it says at least four things. The first is that the valuations of gold companies, I mean the real valuations, not the price earnings ratios, but rather the net present value relative to enterprise value at current gold prices, is the most reasonable it's been in 45 years that I've looked at them. I'm not saying that gold stocks are cheap. I'm just saying that they're cheaper than they have been in my career relative to the net present value of their free cash flows. The second thing it says is that the market recognizes that the larger a company is, the more size it has, the more trading liquidity it has, the lower its cost of capital is. And so there's an increasing need to consolidate simply to make larger players that have larger liquidity and hence lower cost of capital. The third thing I think that this shows is that reputation matters. There are a lot of people who wouldn't own Yamana if their life depended on it because of the capital allocation decisions that Yamana had made in the past. Agnico Eagle suffers through none of that, although Pan American Silver has been weak of late. Traditionally, it's been a premium price stock because the reputation of management, particularly Ross Beatty, was such that people had faith in it. So reputation matters. Lobo made the point that if you've systematically underinvested for a decade in your exploration pipeline, your development pipeline, and your assets, you are by nature cannibalizing yourself. And so both of the acquirers and the acquirer that had the courage to drop out and take the money, I think we're all acutely aware of the fact that if you're not growing, every day your business is getting smaller while you're mining. And there's a need to bulk up for non-market reasons. And I think finally, answering a question that you didn't ask, that this is good for the market. It adds liquidity to the market, which is to say cash. It increases the tradability, the liquidity of the specie that's being issued, and it provides hope in the market. It provides a reason to own a theme in the precious metals market, which is to say M&A. So I think in every regard this is good. And I would also echo Lobo by saying that Gold Fields, by selling, yes, they had some cost, but they acquired the net present value of a pretty good gold mine, which is to say $300 million in cash, by doing nothing. I hope that opportunity comes to me someday.
Okay.
Yeah, that break-off fee was sweet.
Go ahead. Lobo, final thoughts, and we got to go.
Well, let me just say one thing. We've talked about the big thinkers, and we started with this macro thing. I'd like to caution our audience that, big thinkers aren't just leftists. It's not just the World Economic Forum types. We have people on our own side. And if your object is to make money, then you can't let the big thinkers on your own side blind you to what's going on. We need, not to quote Powell, but we should all, as investors and speculators, be data dependent. And we should be looking as acutely as we can as to what is actually happening. And whether we want it to happen or not doesn't matter. Like, there's a lot of people I'm sympathetic to who are deeply opposed to government pushes into this green agenda and the EV boom and all this stuff. It shouldn't be happening. It's not market oriented. Well, okay, fine. Maybe it shouldn't be happening. It should be up to the markets, but it is happening. I mean, just it's happening. There's a story out today about the surprise acceleration in the adoption of EVs. This is huge, and it is deeply impactful for commodities investors. It matters to metals and mining enthusiasts. And you can't be. I'm not listening because it's coming from something you don't agree with. You have to look at what is happening now. And I'll leave it there without naming any names or whatever, but people on your own side, people that are telling you what you want to hear, those are the ones you need to be particularly cautious of, because since you agree with them, it's easier for them to slip you a Mickey. Pay attention, please.
All right, gentlemen, I want to thank you both for joining me and encourage everyone to check out independentspeculator.com for Lobo's free market updates, and also Rick's free portfolio review at ruleinvestmentmedia.com. Gentlemen, thanks very much. I look forward to talking to you again soon.
Thank you, Albert. Thank you, Lobo.